So the 5-year note, if we go to the trade tab and just type it in, ZF, what you'll notice is we can trade futures against this, as I hope you know by now. We have December contract going out in 10 days. And we could already see some of the volume start to trade in the March 2022 contract. And I also want to bring your attention to the option chain. Somebody earlier was asking, how would you trade options? There's options on futures, and most brokers support them. Not all of them, but most of them do. And one of my favorite options on futures trades is on this contract, on ZF. I would much rather trade the options on this contract than trade the actual underlying contract itself. And there's one reason and one reason only why I like this the options on ZF so much, especially when it's moving, especially when I know that the relationship between the 5-year note and its peers is stretched out. So we see that this contract can definitely move, right? We saw what it can do just within a single week. Let me just go back. Just within a single week, this is what this 5-year note contract can do, and we can see that it respects its implied volatility. It got right up to its implied vol, and then it's coming back off. This sort of lets you know that the price of the 5-year note respects or knows that there's risk up here. That if it continues going higher and higher and higher, there's going to be some people that are going to lose money. So those people that are going to lose money, if it keeps going higher and higher and higher, as soon as it gets to that level, they start selling. It's just common market dynamics. So we see that this 5-year note is breaking the implied volatility a lot more than the others, especially lately, right? For example, this is why the back end contracts are the ones that I prefer to trade most of the time, is because they're the ones that give me the most movement. But currently, that big movement is not really happening as much in the back end as it is in the front end. So what does that mean? That means super cheap implied vol, number one. Look at the implied volatility on these contracts. 1%, 2%, 3%, right? So this is very cheap implied volatility. And it's not that these contracts are illiquid. That's not the case. There's plenty of activity that goes on. And in addition to that, the pricing of these options makes them makes the slippage of getting in and out of these options very little, because normally bonds trade in fractions, as I hope that you're aware, right? The options trade in 30 seconds or 64ths in fractions. Well, the options on the future take it one step further. These options trade in fractions of 128. So there's 128 ticks in a point. What does that mean for valuing these options? We know that one bond point is $1,000. So if I'm telling you that rather than the standard 32 tick per point, we now have 128 ticks, that means that each tick is worth $7.81, 81.25, right? So the slippage, the spread that if you have a bid and an ask, as you can see here, there's 3 digits, right, instead of 2 digits, as we would see with the ZV, for example, or with the UV. And notice that that 3rd digit is going from 0 to 2. I mean, it doesn't, you know, since the fractions are, you know, 128, the price increments can, you know, it's not like 141, 141, 2, 141, sorry, 140, 141, 142, 143, 144. It doesn't happen like that. And the reason it doesn't happen like that is, like I just mentioned, if you just take these $1,000, where'd my calculator go? I got rid of it. But if you take the $1,000 and you divide it by 128, you get your tick size. And now you know there's 128 of them. So how do you represent let me do it again. I did 1,000 divided by 128, and that gives us this much, $7.81. So this needs to be represented in ticks somehow. So if how would I represent that in ticks? Like in actual, not in fractions, but in sorry, not in decimal, but in fractions. I would just do it by taking 1, dividing it by 128. So whenever you're pricing an option, keep this in mind, that the price increments are each tick that it goes up, it's going up by this much, by 0.007. And if you do this 128 times, you get to 1. And that's where your bond point comes from. We're used to trading bonds like, you know, $1,000 divided by 32, because that's how bonds are, you know, priced. And we're used to each tick being $31.25 in the futures. But in the options, we get a little bit more control of the tick size. And especially as we start going to the ZF contract and lower, if I'm not mistaken, that there's the 2-year contract is even more granular. I think the ZF contract, the 2-year contract is 256 ticks in 1 point. And here's the part that makes these options so attractive to me is their cost measured in as a ratio of how much theta do I have to pay for the gamma. Because what I really care about is the gamma, the gamma of the position. And if you compare the gamma of ZF options to the gamma of just pick any stock, the S&P futures, SPX, anything, I've yet to see a product that trades options and is liquid that has a gamma profile that looks like this. Look at the increase on both the calls and the puts. If we go way out of the money, right, our gamma's tiny, 0.01, but then we start to get we see a very, very, very large increase. What this means is we get to purchase cheap, not too much out of the money options. And by cheap, I mean the implied vol is cheap, and the theta is I mean, I guess this is marking it at 0. I'm pretty sure it's not 0, but you know, it's not much. And this is going to cost me, you know, less than 3 ticks. So this is, you know, pretty cheap option to put on. But yet, if the ZF contract moves up, look at the gamma profile that I am putting myself into. This is an exponentially rising gamma. And the same thing on the put side, right? Like this is what I like to see. If I put on the S&P futures and we try to compare the gamma of S&P futures that are about the same amount of time, 30 something days, look at the gamma. Gamma is just 0, 0, 0, 0, 0. It's not zero. It's obviously not zero, but it has more than 2 zeros in it, so that's why it's not displaying it. I think I have a setting in, there's a setting in Thinkorswim that you can change so that it shows you more decimal places, but I don't know where that is. Anyway, somewhere display calculations, there we go, here. So if I tell it to show me the decimal places for the Greeks, for it to show me 4 decimal places instead of 2, okay, now we see the gamma. And that's what I'm trying, that's pretty much my message, is that options on ZF have incredible gamma. The profile on them is unlike any other, including other bonds. Here's the ZB. We can see that the ZB trades with higher implied vol, right? The 5-year option, the options on that 5-year future, we saw that were 1%, 2%, 3% implied vol. Now we're on the ZB contract, and these are significantly higher. I mean, if from a percentage perspective, close to 300% more from a percentage perspective, right? Those were 3, these are 9. So these options are going to be more expensive. Buying a 1 lot here, let's say if you buy 1 call and 1 put that are relatively close to the at the money, you're looking at about $1,000 roughly. And the gamma profile on these is also pretty good, but as I mentioned, the cost to movement analysis is nowhere near as good on the ZB options or on the ZN options than it is on the ZF options. And then ZN options are options that I always stay away from, even though they're the most liquid and they also have pretty low implied vol. The reason I stay away from these options is because these things are just priced to perfection. I've rarely made money trading ZN options, and I stay away from them. But I've been pretty successful trading options in ZF and trading options in ZB. And that's one way, one tool that you can add to your arsenal to allow you to trade futures without unlimited risk. Here's one trade you could apply. I'm pulling up a tool that I use to measure statistics on these options, like on over time. How does the future contract, or it could be a stock, or it could be an index, anything that has options, how does it do each time, during that option's lifetime? Does the price tend to, does the price implied by the options tend to be correct, understated, overstated? That's what this tool shows us. It also shows us what the theoretical profit and losses would be if we were to sell an at-the-money straddle at the beginning of every month. Now, I must give you the warning that currently the data that this is displaying is not accurate, because the options on treasury futures don't expire on the third Friday of every month. And this tool is by default set up to the third Friday of every month. So I need to go and change that. Those options on treasury futures expire on the fourth Thursday of every month. So you have to make that adjustment. One interesting trade that the whole reason why I built this tool, by the way, the volatility visualizer, was I wanted to see if I could number one, safely sell options on futures. And my conclusion was not really. I can't really safely do this with confidence. But the whole notion of me putting this together, I spent a lot of time making sure that my numbers were right, because what I was going to do was come up with a strategy and pretty much just deploy it and do it. A continuous strategy that does the same thing every month or every week. If you've never seen this tool, it does weeks and it does months. So you can, change it so that it shows you what it would be like, for example, to sell weekly options every week at the beginning of the week, what your P&L would be. And for example, what the biggest win has been throughout this whole time that you have charted, or what your biggest loss has been throughout this whole time. So it sort of gave me a feel for the different commodity markets that I was thinking of selling options in. And the future that I was most interested in was crude oil. And using this tool, what I ended up concluding is that it's not worth selling options on CL unless the implied vol is higher than 30. And that's just something that one of the things that I was able to kind of conclude on my own, and as you could conclude if you use this tool. It shows you, for example, what the volatility was at the start of the month, what the volatility was at the start of the week, what it currently is, how much the underlying is expected to move today, what's the daily variance, and yeah, the important metric that I like to look at is out of all these 10 years worth of data that we have charted, we do have 10 years charted. What percentage of time did CL close inside of the straddle? Meaning, if I would have sold the straddle throughout these 10 years, I would have profited 84.44% of the time. Now, of course, I have not been selling weekly straddles, but this is a tool that kind of opens a lot of doors for creativity, in my opinion. It opens a lot of doors for somebody who was asking about rules, like what sort of rules do you give? And I think there's really no rules other than the ones that you give yourself for discipline. How do you manage your money? How do you manage your account? I don't think that rules for a specific trade would work, just because you may trade a certain trade a certain way, but somebody else may want to do it differently, or your risk tolerance is not the same as somebody else's, but you're still taking the same trade. So that's why my response was the only rule is don't let your account go to zero. So by using these tools and more specifically statistics like this, like knowing that 84.44% of the time, and just in this example, every week, the CL has a tendency to mean revert and close inside of that weekly straddle. So that this means that buying weekly options on CL is really not a profitable trade. So if you were thinking of buying weekly options on CL and you look at this number, maybe you rethink that approach, or perhaps you wait until the times that it has been profitable in the past. And this tool also shows you that. When has it been profitable? Whenever there's been a loss. Remember, this tool is the statistics here are from the perspective of the seller of the options. So when the seller of options loses money, the buyer of options wins the money, right? Like it's a zero-sum game. So what has been the biggest loss for the option seller? Well, the total winnings have been 1,453 points, which is $1.4 million over the course of 10 years. Again, selling at the money straddles every single week without skipping a week. And the total losses have been 116.71 or $116,000, 116K. So obviously in this case, as you can see, the losses are a lot smaller than the winnings. But let's see, for example, what the biggest one in each category has been. The biggest winner, 118.6. The biggest loser has been 5.96. So since the biggest loser has been 5.96, that means that as the buyer of options, whenever this week took place where the option sellers lost $5.96 in 1 week, that was probably a week that they were not really pricing in a lot of volatility, and there was a giant freaking move. I can't really spot it. I don't know which week it was, but you can find it. And if you're going to look at the monthly how the monthlies have performed on CL, also keep in mind that the CL also has options. You can go and type CL and you'll see that it has very liquid options, but the expiration on those monthly options is not the same as the expirations on the bonds. So the crude contract, if I am not mistaken, I believe it expires, I can't recall if it's on the 4th Tuesday or the 3rd. It's different. It doesn't have the same pattern. So if you are going to look at the monthly ones, just make sure you're lined up, right? Like make sure you're actually setting this to what it should be. For the monthlies. For the weeklies, it doesn't matter, obviously, because the week starts on Monday and ends on Friday. Oh man, guys, that's such a great comment. Thank you so much for that. For your comments, folks. Seriously. Thank you for your comments. I'm not sure how to pronounce your name, but I'll give it a try. Sachin, I hope I got that right. Yeah, great. Is there a link for the vol visualizer on the website? I believe there is. If not, I would email support. And then as far as questions about if you can only lose the amount of premium paid on the option, correct? Carl, yes, that is correct. And that's why I made the comment that if you're going to trade futures and you're looking at them and analyzing their risk profile, and you understand that they do have a theoretically unlimited loss potential with futures, as I hope we all know that, right? Like with leverage comes responsibility. How can we still get the same upside and the same benefits of the future contract, but without that unlimited risk, without having to worry about getting margin called? How can we do that? The answer is options on futures. Because just like an option on an equity, you can only lose the debit you paid. And now, this is not the case for selling options. If you're selling an option, you have unlimited risk, right? We don't want to sell options in this case, especially not with, you know, fast-moving markets. And by the way, when you sell an option on a future, you are definitely affected by margin. So if margins go up and you're short an option, guess what? You're going to have to post margin. So being short an option and being either long or short a future, I sort of see as the same. They don't really cap my risk in any way. Tail risk, that is. So but if I'm on the long side of the option, the only amount that I can lose is however much it costs me to buy that option. And once again, my favorite one is fees. Just because I have to pay so little in terms of theta to acquire all this gamma. So anyway, I hope that this has been informative. Thank you so much for your time. Thank you so much for your attention. Hope you have a great weekend. And if you have any further questions, I'll be on Discord. I got to read all these comments. You guys are saying so much nice things. Thank you to everybody. Really appreciate your comments.